Good evening, everybody. It's Jeff Gibby over at MetaStock. How is everybody today? Hope you're doing well. I want to make sure you guys can hear me. Just spent about 3 minutes talking to myself, so I do want to make sure you guys can hear me. If you would, just kind of chat in. That's okay. Thanks, David. Thanks, Dennis. Thanks, Scott. Thanks, Jim. Okay, let's go ahead and read some legal disclaimers. Don and Terry, thank you too. Apparently I'm being well heard. That's great. Very good class. You guys, we had a huge amount of registrations today, so you guys are very interested to see this topic, which is great. Let's go ahead and get started. Today's demonstration is designed to instruct you on using MetaStock, the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. All right, let's go ahead and go to the next page. Roy Swanson is somebody we've had in our webinar room quite a few times now. I really like Roy's no-nonsense approach, and he's going to be giving you a class that apparently a lot of people are interested in today. So, Roy, let's go ahead and get you on here.
Hi, Jeff. How are you doing?
I'm doing good. Can everybody hear Roy? I can hear him. Yeah, everybody can hear you.
Great.
All right, let me turn over the screen control for you. Frank says yes. Let me go ahead and turn over screen control, and let's get you kind of all situated that way. Change presenter.
Okay, so let's begin then. Thanks for that welcome, Jeff, and thanks for everyone for coming. I think we do have a good session for today. We're going to talk about using a concept we call triangulation, using 3 indicators on MetaStock to create some accurate trades. Of course, I have to show the disclaimer as well as the presenter, and the disclaimer basically says that we're not brokers or certified financial planners. All the posted results are illustrations based on simulated historical trades, and past performance of this system is not indicative of future performance. This information is solely our opinion to be used for your own explorations. A little bit about me. I'm the founder of a website called steadytrader.com. Been trading about 20 years. I started when the online trading actually just started up. I guess it was the late 80s, early 90s. Actually was in talks with DLJ to work on derivatives for them because they found out I was a math geek, and but I just went on to be a consultant to various trading system providers. My partner and I have about 25 years experience, so we know the strengths and weaknesses of a lot of trading systems, and also why individual traders have trouble even with good systems, and we try to put the information out on Steady Trader that helps individuals trade smart and trade using professional disciplines and proven techniques. So today's agenda, we're going to talk about how to scan, really create accurate buy signals. And this has 3 components. One is to set the right goals. We're going to talk about setting goals based on activity, timing, and targets. How to use the right corroborating indicators, I should say, and that's where the concept of triangulation is going to come in. We're going to talk about eliminating signal drift, what I call signal drift. Any signal system, any database system is going to have drift to it. If you could press a button and run a machine to generate signals, well, I think we would all be as rich as Warren Buffett. But there is drift, and we'll talk a little bit about that. And then we're going to talk a little bit about decision theory and the decision theory that went into this system, this methodology, and why it results in making good decisions. At the end of the presentation, I'll be showing you how to get a copy of my free ebook. It's called Read This First Before You Buy Stocks. This is a book that I wrote about 1.5 years ago. Did a lot of research on the current market changes, the fundamental structural changes in the current market, and it's a good read, about 80 pages. And we really think that people do need to have new rules for the new stock market. In fact, I saw a comment by one of the top traders at Morgan the other day. He was talking about how even today, it's 2015, most people are trading like basically like it's 1970, in the 1970s, they're still using that kind of thought processes, and it's just people have to start to wake up and see that the market has changed. So we are going to be talking about systematic trading, and I assume everyone here, if you have MetaStock, you probably are into systematic trading. I just wanted to define it a little bit. I contrast it to trophy trading versus systematic trading. Trophy trading is what you read about and all the hype and all the ads, big wins. And the problem with trophy trading, all this stuff about, buy this stock, it's going to go up 200% or 350%. Problem is this is all needle in a haystack. They're just not around these giant wins, and it's high risk because when you identify what you think is going to be a big win, well, then you have to put a lot of money behind it, and the risk is high. There aren't really any tools that are going to show you a big winner. It's usually news or information or something along that line, and it's a low percentage play. It's kind of like hunting. We think systematic trading is superior because you get consistent wins. The winners are available every day. It's low risk. You use tools and you use professional discipline. You use tools like MetaStock. It's a high percentage play, and it's like farming. And I think humanity discovered centuries, eons ago, that it takes farmers to run a civilization. It takes farmers to do the right things, plant the right conditions, and harvest a little bit every day. That's what builds great civilizations, not going out and bagging an occasional piece of big game. So let's set the right goals. Let's talk about the first step in this. The goals have to do with activity, how often you want to trade, and how much time you want to spend trading. You have to figure out what your time horizon is going to be in terms of your position hold times and your gain targets. And these would be things like your percent per trade, that's going to be your target when you exit, and what kind of ROI you expect to get for all your effort at this. So the problem with goals is that the market has changed, as I said at the very beginning, and goals have to be reflective of the market as it is and not as you wish it would be. So we know what the market is now. I mean, this is one whole year of the Dow. I'll tell you why I use that later. We don't use the S&P, but they're almost equivalent. And of course, the market is right now lots of short runs up and down, changing bias every couple days. We had a little correction, and it seems almost as if we're at a new set point. Not sure it's going to break out of its, might have a slightly wider range while it finds it. But the point is that this is the new market. It's been a year. We really have to trade this new market. The market most people are trading is the market as it was. There were long runs up. It was just going up, and the runs would last for days and weeks, and it was a lot simpler to trade. So the new market is short, strong cycles. It's short profit taking by the big block buyers, the institutional buyers. They're taking the profits as soon as there's a move one way or the other, and that's not going away. And because all these institutional players are all on the same page, let's face it, they're all using the same basic computers, the same basic programs. So this short cycle thing that we see now, the market going up and down, giving and taking, it's not going away. Because again, the big volume buyers are all on the same page and using the same basic playbook with small variations. So when we look at this, we have to first decide for ourselves, what's our activity level going to be in this market? And I'm going to use an example. Some of you may have seen this before, but I take an example from the worst period of trading in our lifetimes, and that was the crash of 2008, 2009. These are 5 months, and if you were a long-term trader, if your activity level was kind of low and you were just taking long positions, well, basically, we all know people who traded like that got killed, and the crash was real. But if you were a bit more active as a trader and you were in and out every week, well, you can see that there were 5 weeks were up out of 20 weeks total. The crash was tough, but it wasn't quite as bad because you could recoup some of your losses in those up weeks. Now, where it really gets interesting is that if you look at it on a daily basis, and if you decide to be an active trader and get involved on a daily basis, well, look what you see here on the worst period in our lifetimes. 41 days were up out of 105 total trading days. That's 40%. I mean, it's not that far off of a 50-50 market. All those green lines at the bottom, versus the red, almost half of the days were up. Simple trading indexes would have helped you, make gains, offset the giant losses that long-term guys are having. So the point here is that if you have an active perspective, a daily perspective on the market, I'm not saying you have to trade every day, but to be engaged, looking for trades every day, you're much more likely to survive and actually succeed in even the worst possible market conditions. Short-term traders, I like to say, what crash? I mean, it's almost non-existent. Now, the second thing I talked about in terms of goals is setting a time horizon. And we're big believers that shorter is better. This is a long-term trend. I think most of you are probably aware of it. 1960, the average hold on a position was 8 years. Last year, it was 5 days. The pros are trading, minutes to seconds, high-frequency trading. Of course, we can't do that. But the point is that holds are getting shorter and shorter and shorter. And in my mind, one of the big reasons to advocate or to use for yourself a short-term hold strategy is that you avoid corrections. If you always think of it this way, if you're always taking your money out of the market, forget about putting it in. You're short. Your holds are short. You're always taking out every day. You've always got positions you're closing. How much damage can be done in a day or two? I mean, you're always taking money out. So it's really a safeguard against the corrections, and it could be a correction as big as the one that took 3 or 4 days in August, or it could be a correction, what I call these mini corrections that happen every 2 or 3 days as the market pings back and forth. Again, the point is that getting into this active mindset of daily engagement, almost daily trading, and short-term holds, money in and out of the market constantly, it's a much better proposition in terms of protecting yourself from downside, forgetting about the upside. Now, in terms of gain targets, once you start to realize, that you're going to take these first two methods to heart, your gain targets have to be modest and realistic. I mean, if you're only holding short positions, there's not a lot of time for a position to make a big gain. So we're talking about looking at modest gains, 1 to 5% maybe. And the nice thing about this is that they're always available. There's always gains like this available. The holds are short. They're not getting much more than this. You don't get into fantasy trading or trophy trading, waiting for the 150% winner. And the fact is that there are really very few long run-ups anymore. I mean, they just don't exist in this market, especially the market that we've seen for the last year, which has been incredibly range-bound. Now we're going to talk about triangulation and using the 3 indicators, and as an example, we're going to use our favorite strategy, the one we have at Steady Trader. It's called the green light trading strategy. Again, it's designed, as we've been talking about, to trade through what I call these never-ending cycles of profit-taking pullbacks. So we use short, quick moves, 2-day average holds, a modest average gain per trade of 3.8%, and highly accurate signals, and that's what you get from the triangulation. So the first thing is, okay, we get to the meat of it now, and that's picking the appropriate indicators. The indicators we feel need to be based on the modern market, as we said. Let's not trade the market of the 70s. Let's not trade the market of 2 years ago. Let's trade today's market. And we need indicators that can show us short-term moves that are going to work for us in the next few days. Now, the problem with most technicals, and I don't have really any problem with any one technical per se, but most technicals trade the old market. They trade the 1970s market. Candlesticks have been around since the 18th century. Elliott wave, he developed that data on trading that whole theory and whole formula based on data from the Civil War to the Great Depression, from the 30s, RSI, 78, Bollinger Bands, 80s. All of these very popular technicals, and really most of them come from the days when the market moved at a much slower pace and it locked into patterns, of long, slow gains over time. That's why we start with RMO. If you're using MetaStock, you probably know it's a big favorite at MetaStock, and we love RMO mainly because it was developed roughly in the mid-2000s. It's a modern market indicator. It's one of the few that really was based on data that reflects the market since the advent of online trading and all the fundamental changes. Now, basic RMO, be that as it may, it's also kind of, you see these buy signals. Here's just a chart. Typically, it's pretty accurate, but it'll show long run-ups. And again, we're looking for much shorter positions. So we start with basic RMO, but then the first part of our triangulation is we use it in conjunction with Wilder's measurements, the ATX, the PDI, and the MDI, to tighten it up. And what happens is we get signals that look like this, and I'll just show you a few. This is one from August. Typically, we look for a run that's going to be maybe 5 days tops. 1, 2, 3, 4, 5, 6. This one's 6. We get in here. By the second day, it's up 7% after the signal, and then it flattens out. So what happens when we combine the two indicators is we get, unlike those long run-ups that you see of normal RMO, we get these tight trends. Flat, flat, flat. Basically, we get the signal, bing, 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 up. This one was up 37%. This was a China bear fund in August. Of course, that was the right thing to do in August. Here's one just from a couple weeks ago in September, and again, you can see really not too much going on here. There was a decent RMO signal here, but then this was the one that we caught using RMO and the Wilder equations, and we had a nice tight trend of a few days. We get in and get out 17%. So this is sort of the advantage that we feel in this type of methodology for using RMO with the Wilder. Now the final triangulation we use RMO, we use Wilder's short-term trending, we use order book buying pressure, or as MetaStock calls it, the on-balance indicator. We overlay that. This is the third component of the triangulation. And what we do is we use it to corroborate. Once we have a signal, and here again is the same one we just looked at, we make sure that the on-balance, the buying pressure, and this is basically, I'm summarizing, but it's basically your order book pressure. It's what's on the books at the end of the day. And if the buying pressure is up, which we want to see, that corroborates the signal. What you don't want to see is the buying pressure here going down. But typically, you'll see if the buying pressure is up, the stock's moving up. As soon as it goes down, you see it flattens off here. You'll see it goes down here, and the stock goes down. It's a pretty good leading indicator, and it definitely works in tandem with the other two to corroborate the strength of the signal and basically prevent you from getting into a situation that might not trigger the way you want it to. So those are the three indicators: RMO, Wilder, and the on-balance. Now, why does this work? And I'll just give you a little bit of decision theory here. And the basic premise, one of the basic premises in best practices decision theory is when you have a big decision, you break it up into multiple small decisions. And you can see here we're using three indicators, so there's multiple decisions going on. Of course, we think it's a big decision to make any trade because your money's at stake. So we break it up into these multiple decisions using the three indicators. There's a law that's known as the law of compensating errors, which means that even if you make multiple decisions in one decision, you may get one or two wrong, you may get three or four right. The point is that the errors will compensate, and you can't get too far into a bad decision. Now, it's more than just using multiple inputs for decision making, though. We also believe that there has to be what we call a triage process, borrowing from the medical profession. Prioritizing the decisions, doing them in a sequential order, and using selective filtering. And this next slide really basically is the meat of the whole process of why the green light example with the triangulation works. We start with RMO. Okay, RMO is kind of what I call it a medium-term indicator. It's binary. It's kind of up and down. You get the buy signal, you get the sell signal, but that's it. It's pretty much cut and dried, and it's a pretty complex formula. We pair that up with Wilder, and we do the settings in Wilder to make it short term, and that starts to rate the strength and the life cycle of the signal, the growing trend, the weakening trend, that kind of thing, how strong it is. So you got this. So first of all, you're tightening up your time horizon. Second of all, you're going from a binary signal to a signal that has some sort of parameters in terms of rating the strength and whether or not it's getting stronger or weaker. You've got a complex formula and a simple formula. So these indicators have different strengths, but together they corroborate. And then finally, with the order book pressure or the on-balance indicator, we're adding another set of basically valuable inputs. This is immediate. This is what's on the books. Okay, this is what the order buying pressure is right now. So we're going medium, short term to immediate. It also rates the strength, so we get another rating, which is basically seen by the slope of that line, how steep it is. And as opposed to something like a formula, a mathematical formula, or calculus, or whatever you want to say, this is pretty much a direct measurement. This is basically reading the order book and then putting some numbers to it. So when you put these three together, and this is why the selection of multiple indicators is so important. You don't want to use the indicators that are all kind of the same thing, that all work on moving averages or whatever, and don't have different strengths, individual strengths. What we have here are three indicators that each have different perspective on the time horizon. They each give you a different type of output in the reading, and they're basically fundamentally different in terms of the sophistication or the complexity of what they're built on. And that's why, again, we feel that these three do work together, and I mean, the strategy has done extremely well this year. It's over 80% accurate. So I'll leave that up just a little bit more so people can understand this. This is an extremely important principle. Again, this is not just throwing random indicators together, but indicators that have different strengths and weaknesses. Finally, after the signals, we do one last exercise, and we need to eliminate drift. We call drift is a big price move that's caused by something other than these fundamental price pressure, chart pattern, whatever you want to call it. I mean, we're a big believer in database trading, but at the end of the day, the media is out there wreaking havoc on the stock prices. We call it drift because the media goes out there blowing strong, and they generate all kinds of price moves. All database systems are affected by drift, so we make a final determination, checking the news of the day on any signal to see if it's being skewed by the drift of the media, if there's a merger or an acquisition, or a good or bad earnings report, or a company scores a big government contract or loses a big contract. We just look for very, very important bits of news about the company to see if the media has been covering it and to see if there's any kind of drift going on. The other thing we do, and I think this is also hugely important, and this is why we showed the Dow instead of the S&P earlier, is we trade outside the storm, by and large, with this method. When you think about it, we talk about drift, we talk about the media influencing stock prices. You never know what they're going to be reporting between when you order your stock and when it executes. We avoid the spotlight. We really don't go into the S&P 500 because that's what the media is covering. So we avoid the spotlight stocks. We trade outside the S&P 500. And as I said earlier, we check the news. We look for extreme good news or bad news. So it's basically we do two things to trade outside the storm of the media, which is basically, we can, like I say, doing a lot more harm than good for traders who are trying to trade systematically using data. What about August? I just want to give you a quick example. In August, our system that uses this triangulation, the Greenlight system, we had the best 3 days in the year using bear ETFs, leveraged bear ETFs, and it was the best month of our year. These are just a few of the trades we hit. This type of system using these three indicators identified not just FXP, which I showed you before, but several other trades in rapid succession. These were all 2 and 3 day trades, and as you can see, these were all double-digit trades. These really stacked up. again, with a system like this, it's going to identify and help you to actually make use of leveraged ETFs, because leveraged ETFs, a lot of talk about them, a lot of people have trouble making them work with this system because of the time horizon, because it tightens up RMO into basically a 2 or 3 day trade. This tends to be the kind of movement that you get in leveraged ETFs, and the bear funds are a great way to simplify making a good profit when the market's going down. These are the quick results. You can see the net ROI on the portfolio. August was the best month, but it's typically, we run about 7.5% a month. We've been doing much better than the S&P all year, and the win rate has been about 84%. Finally, we'll talk a little bit about money management. We've talked about the signals, we've talked about triangulation. I just want to say 2 words on money management, because that's the other key to successful trading. It's basically, in my view, 50-50. If you've got these signals that are just signaling quick trades, trends that last, whatever it is, 2 to 5, maybe 6 days, you need money management plan to trade like that. We teach what we call a quick cycle portfolio, basically cycling money in and out of the money every couple of days. Again, our average now is a 1.9 day hold. So basically, it's cycling parts of the portfolio in and out. And as I said before, this is a great protection for corrections, for swings in the market. Because yes, you're always putting money in, but yes, you're always taking it out. So the fact that you're always taking it out, you're always taking your gains while they exist, before they get eaten up by the next market swing, just take the money out and just add it up. It all starts to add up. And so we teach, basically, we call it a quick cycle portfolio as part of the strategy. If you are interested in looking at the strategy, we offer it with full instructions on how to run the scans and validate the signals and MetaStock, placing the orders and managing the portfolio. We have a scan room, and we publish the signals, so we help people make sure that the way we teach it is the way you learn it. If you're new to MetaStock, MetaStock has an offer to give a free month on the system, on the end of day MetaStock, for people who don't already have it. And I want to thank you for coming. That's the end of the presentation. If you want to find out more about the strategy, it's at steadytrader.com. Again, it's all based on this triangulation that we talked about. We've got some videos up there. If you'd like to request a video from our scan room, please send me an email. I'll flash that in a second. We basically, about once a week, we send out videos, and we'll actually show you, if it were today, we would show you yesterday's scan. We show you how we run it in MetaStock, and then you'll see what happened today. So it's what you see is what you get. I can send you a copy of this presentation, and you can also get a copy of our book, Read This First. It's also available at the website. So again, if you do want to see a video of our scan room using this methodology, the green light methodology, with 3 indicators used sequentially the way I described it, just send me an email to info@steadytrader.com, or go to the site and sign up for one of the videos. You can do it there as well. Get your free copy of the book, or you can always, of course, call us at the number on the screen now. And that's really about it. I want to thank you all for coming. I'll be looking at the question board now for a minute. See if anybody has any questions. Just type them into that question board. I think I'll see you. Okay, let's see. I think I've got one. I just have to scroll down. Can this be used? Yes, this is MetaStock end of day. We do it at the end of the day. We like to keep things simple. Okay, I'm just scrolling through these questions. Run in MetaStock 11? I believe so, as long as you have basic RMO. That's all you need. The other indicators have been in MetaStock for quite a ways. Can't be used with end of day, yes. What were the three Wilder indicators? MetaStock has the PDI, the MDI, and the ADX. We use all of them. We basically lump them together and corroborate the RMO signal. RMO is a black box. Yes, how do we validate its usefulness without seeing the code and knowing how it functions? Good question. We knew a little bit about it, RMO. We read up on it. We took a look at the formula, although not extensively. But what we knew is what the output of RMO gives. We did quite a bit of looking at it historically, and again, it was a question of taking the Wilder indicators, and then at the final step, the buying pressure to just tighten up RMO. Again, the point is that we know what these indicators do at the end of the day, and so because again they each have different strengths and they each do something different and they do it in a different way, they all sort of dovetail and they fill in the gaps or the weaknesses that any one particular indicator might have. Hold on a second. See a couple more questions coming up here. Does your system provide us with a toolkit to run locally on our system to find trading candidates, or do you simply send subscribers a list of your picks? No, we actually teach the strategy. We actually give the rules. We show how to set up MetaStock. Basically, there's a few little customizations that we do. We show how to run the scans in the right order, and then how to interpret the results. So we do actually give you the actual keys to using MetaStock. And then, of course, once you have that, you could customize it, especially to your own risk profile, which is the advantage of owning any strategy, is that you can adjust the risk profile. We do also have the signals product if people, they really don't want to do the work, but I think, most people who have MetaStock like using it. We sure like using it. It's a really easy tool. How many signals do you get a day with the signal subscription? Yeah, now that's a very good question. I didn't cover that today because we're talking about triangulation, but we are big believers in just a couple signals a day. Maximum 4. Generally, at least 2. There are some days you get none, but almost always there's at least 1 or 2 signals. So again, when you have a few signals, then it's possible to actually fund them with a modest-sized trading account and actually make trades that are, basically worth executing. We're not big believers in long lists of trades, long list of signals, because then you've got another decision to make, and we like to trade on the numbers. So the method actually is self-selecting and gives a very few signals. Does this work on a starting account of $5,000? Well, we run it against a model of a $25,000 account. The reason we do that is that if you're an active trader and you're trading basically almost on a daily basis, you do have to stay on top of basically the 3-day rule of pattern day trading. So, if you're going to be in and out using the system fully, you need the money to fund that, and that's a minimum, as I think most of you know, of $25,000. If you're just going to trade, every Monday or something, or only trade once a week or twice a week, then you could use a smaller amount to fund the account. You like the ability to tune parameters on your own. So I like that approach. Yes, again, well, we do have, like I say, there are parameters in here that we can tune. I didn't get into that on this presentation. There are other presentations up on the MetaStock YouTube channel where I do talk about that. But there are several places where you can tweak it. There are tweaks that we make based on what's been happening in the market over the last day or two in terms of the very, very short-term bias of the market. We take a quick scan on that every single day. We take the pulse of the market, and then that gets injected into the whole formula. We also can basically change the risk profile. It's very easy to do that, so that if you're feeling, conservative or aggressive in terms of risk, again, and that's the advantage of using any kind of strategy like this, or actually having the rules. Need I dare ask what the cost is? The cost is $289 for the strategy with all the rules and everything. What are the time frames, real time, to get in and out? Well, we're averaging now about a 1.9 day hold on average. This has changed. I was talking about how the market's changed. Last summer, a year ago, 15 months ago, we were doing over basically a little bit close to 3 days on an average hold, and now it's under 2. So again, and when you think about what's been going on in the market, that's a perfect reflection of what's been happening in the market, how it's so more and more tightly range bound, how the profit-taking cycles are quicker, and we didn't do anything to make that hold time basically decrease by 50%. The system is just doing it because that's how it works. It adapts to the market as it is. Again, my point of being the market as it is today, not as it was last year. What's the cost again? The strategy is $289 for the whole package. You get the rules, you get videos, you get the scan rooms, and you also get the daily signals from us. We do have a signal service that's $49 a month. You'll see that on the site too. But of course, you can't adjust the signals. You just have to go in there and look at them. Does the model assume next morning market order entry at the open? The strategy itself uses a what we call a target entry pad. It's a pad that's basically above today's close. So I think you probably could tell based on the indicators, this is a trend strategy. We're identifying very tight, very short-term trends, and as an extra measure of safety, and this is what gives accuracy, there's an entry pad of somewhere between, generally, the range is between 0.6 to almost 1%. So the price actually the next morning has to hit that entry pad. It has to go up, let's say, 0.8%. What that does is it demonstrates that the trend is real, that the trend is happening tomorrow. We place the orders with a stop. You could put a stop and a stop limit if you want to really contain the entry, or you could wait until the next morning and see how the market's doing and do your entries there. But the system is designed to be done end of day and to put the orders in overnight, the night before. Let's see. Is there a discretionary component to our historical results? There is. We knock those results down. We understate them by fully 20 to 25% because we realize that not everyone's going to get optimal results. People have different broker commissions. So we actually have reduced all our published results by 20% to allow for that kind of slippage. Is there a monthly charge for the signals? If you buy the full strategy package, you get the first month of signals free. You can always subscribe to the signals separately. It's all at the website, steadytrader.com. Can you buy this after today like it is purchased through the website? Yeah, you can purchase it on the website. We trade stocks. This is a question says, do you trade stocks or trade options on the stocks? We're not options guys. I think you could use it for some types of options, maybe weekly options on a Friday. This is a real simple strategy. It's a trend strategy. It's all long positions. We handle negative markets with leveraged inverse ETFs. it couldn't be simpler, and we like it that way because we're not big believers in getting too complex in the actual trading mechanisms. We'd much rather have, again, the accuracy of the signals from the triangulation. Is it a long-only strategy? Yes, well, I think I just answered that question. We don't do shorts. We do scan the list of bear, what I call bear ETFs. And we really only take the 2 and 3x leverage ETFs. And I gotta say, this year, of course, is different, but this year, I would say, out of our top 20 trades, probably 15 of them were inverse ETFs, 2 and 3x ETFs, and they've just been, we do not fear, let me just say, we do not fear a negative market because it's been quite rewarding. Another question here, is it difficult to set up in MetaStock? Not really. I mean, it's almost embarrassingly simple. There's a few parameters we set up. The work involved, I'll tell you, basically the scans are short. The scans take basically about 15 to 30 seconds, and there's 2 of them. The real work comes in looking at the signals and knocking out the bad ones. Because again, we talked about drift. So setting it up in MetaStock, running the scans again, and this is why we like MetaStock. It's very, very quick. And then there's some interpolation on your part, but it's not like interpolating chart patterns. We basically give you simple up or down questions, task on every signal, and then take the winners and lead it down to 2 to 4 per day. How much cost if I only want the signals? I don't find value in the site. The signals are $49 a month. I apologize for going slowly through this, but I have Windows 10, and I have to scroll line by line through these questions. When you test it to determine the system might perform non-trending environment, or the markets eventually revert to long cycle moves in the past, or have you concluded that the automation and easy online brokerage access has permanently shifted the market to short term? You know, so that's the question. The question is have we concluded that, you know, all the new fundamental shifts in the markets have permanently shifted the market to a short-term orientation? And I think, you know, big picture, yes. I mean, let's face it. There are different estimates out there, but roughly they all agree that something like 90% of the volume of trading right now is high-frequency trading. I mean, we're there. And you know, there's no reason to think that that is going to change because this fast pace of today's market, when you think about it, it mirrors everything else in our society, the fast pace of communication, from email and texting, you know, the pace of business is quicker, the pace of law is quicker. Everything has ramped up in the last 10 or 20 years, largely due to the internet. And I think the same can be said of trading. We are just in a place now where automation and computers have made this possible. And for trading, again, as I tried to point out, when you have shorter holds, you have less exposure to the downside. It's more work. Yes, it's a lot easier to just set up a trade and see how it does 3 months later. But the fact is that just doesn't work anymore. I think BlackRock published a study last year that showed that the average portfolio of a long-term trader was 2% a year, which is pretty miserable. So there's a little more work involved getting in and out of the market on a quick basis like this every couple of days with your trades. But as I will say repeatedly, got to trade the market as it is, not as we wish it were. Can you use it without MetaStock to filter out the wrong signals? I'm not sure about using it outside of MetaStock. I know we've had some people try using TradeStation, but again, we like MetaStock because MetaStock has really made using RMO very simple. And the heart of this is RMO, And RMO works, in my opinion, because it's a modern indicator. Because it's the only real popular indicator when you think about it that's been developed since the year 2000. It's just, I mean, and again, this market, the markets since in the 2000s are not like the markets of the 70s, 80s, 90s, or whatever. Info just steady trade. I'm not sure why you couldn't get through, but I will take a look at that. We did recently move our DNS, so there could be a little bit of a problem there. You could also try Webmaster at Steady Trader. Anyway, I will look at that after the session and see if there's a problem with the email. I'm not sure why, though. We have Google, Gmail. What time do daily signals? The daily signals, we try to get them out, and we're pretty good at this by 8 o'clock Eastern Time at the very latest, between 7 and 8. So you have to check the charts, also the expert advisors. Well, we use explorations for the RMO and the Wilder, and we just basically, if you're familiar with MetaStock, you just drag the on-balance indicator onto the chart. Then pretty simple, and it's a three-step process to get all three indicators on the one chart. Sounds like it might be a good plugin, possibly. But and again, I didn't get into this. We're not advocates of push-button trading, and I think if there were such a thing, again, they're paying a lot of people on Wall Street millions and millions of dollars a year to do something that's more than pushing buttons. There basically is a human component to this as you look at the charts and look at the signals and look at the output. We make it very cut and dry. We make those up or down decisions, yes, no, when you look at the signals, so you can either take or reject the signals. So we try not to make it discretionary. We try to make it cut and dry. But at the end of the day, there's a little bit of a human touch to this. And again, that whole concept of eliminating drift that I talked about, that has to be done with a bit of looking over the results. And that's how they do it on Wall Street too. The quants don't make the buys. The quants come in with a report of trades that look good. But, the trader, the money manager, he's the guy with the responsibility, and he evaluates the data, and then he decides to make the buy. How long have we've been offering it? A little over a year now. Okay, I'm going to make last call for questions. This has run almost an hour, but I do thank you for all the interest. And I will definitely check to see one of you had trouble with the email. If you do have any trouble with the email at info@steadytrader.com, I will definitely get that addressed and post something on the homepage. But it could have just been a fluke on that one gentleman's email. You're welcome, Jim. Thank you for your positive feedback. I think I've gotten all the questions. If you, thank you, Ricardo. Thank you for coming. No problem, Charles. You know, and we've worked, as I said, I've been a consultant for trading systems for 25 years. Like just about any system out there, the price is negligible if you trade it and make money with it, but it is what it is. Okay, one last call for questions. Give it about 10 more seconds or so. If you got a question, pop it in here. Otherwise, I want to thank you all for coming again. I'll take a look at that email issue. And hope to see some of you on the site signing up for the videos. Again, there are a lot of places where you can sign up for videos and more information on the site. So don't hesitate to go there or use the phone number that's on the site. Shoot me a voicemail and I'll get back to you. We can talk about it. Yeah, I believe MetaStock will send you the recording, Vic. If you want to pop your email in the question box, I can make sure I send it. But otherwise, I think we can trust that MetaStock will get you the recording. They also post these. They post these on their YouTube channel the next day or so. So just go to the MetaStock homepage and look at their community, and you'll find their YouTube channel, and this will be on there. Okay, I've got your email there. The ebook, you can get that. Just go to the site. You'll see read this first. You just go there, click on the link, and it'll take you to where you can get the book. Okay, I'm going to sign off now myself, Charles. Thanks again, everyone, for coming. And again, there's plenty of places at Steady Trader where you can sign up for information, stay in touch, and use the phone number, and I will definitely look and see if there's anything really going on with that email. Okay, I'm going to close down the room. Bye now.